Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you IUL insurance and really go over the pros and cons of an index universal life insurance policy, and how an individual should be looking to leverage that type of contract for a type of retirement accumulation or an eventual supplement to their retirement income at a later date that has a bunch of tax benefits, in the long run. So what happens is an index universal life insurance policy is a type of life insurance policy that an individual could leverage cash value accumulation through something known as indexing strategies. So what happens is an index is essentially a type of interest credit that is computed dependent upon how a stock market index performs. But rather than if a regular stock market index goes down, with indexing, what happens is that individual has a 0% floor. So if the market goes down, they have a 0% gain into their account. If the market goes up, then they're capped at a specific limit depending upon which company, depending upon how powerful, that indexing strategy was. So you might have one company that has a 17% cap as opposed to another company that might have that same sort of index with a 13% cap. So different things to kind of shift through is saying with this indexing, you have to make sure that you're going through the pros and cons of each type of contract and seeing whether or not it may, be particular to your goal, to your accumulation goal, your eventual retirement income goal, at that later date. So the number one question that you have to really understand is, do I want to try to set up this plan for max accumulation, meaning some sort of accumulation that's going to act like a savings account that I could eventually pull from at a later date and time and make sure that this is maximized? Or are you looking for it primarily as a death benefit play, meaning that as long as I'm placing dollars into this type of plan, I don't care so much about the accumulation, about the savings account aspect. I'm looking mainly as that death benefit aspect, saying if I pass away too soon, I want to make sure that I have a maximized death benefit going to my beneficiaries. Now, if somebody answered the question saying I want to have a maximized death benefit, then I highly recommend against you being placed into an IUL product. Reason being is because you have death benefit type maximization policies such as guaranteed universal life plans, you have whole life insurance plans, you have laddering strategies through term insurance that could make sure that you're accomplishing that death benefit goal in a more efficient manner. So what brings us to this max accumulation plan. So right off the bat, if you already heard this part, in the video and you say, well, I was interested in a death benefit plan, so, maybe I shouldn't be listening to it, going further. I recommend you don't listen to this going further. Now, for the individual that's looking for the max accumulation plan, how exactly can we accumulate the growth within this sort of cash value aspect, within that sort of cash value account? And it goes to the very basics of how a permanent life insurance policy works. What happens is an individual would go and place dollars into a permanent life insurance policy and kind of think of it like this little egg shape. And the costs that are associated within that egg shape have to correlate to something known as a death benefit. Remember, the L stands for life, so it has to be life insurance. With life insurance, there has to be a specific type of death benefit involved. You're not going to have life insurance with no death benefit. That's an impossible type contract. So there has to be already it has to play within the terms of being deemed a life insurance policy. So if someone's placing premium dollars, well, we understand that there's going to be a portion of those dollars that are going to go to the different costs, such as costs of insurance, such as the net amount at risk, the risk associated with whatever the portion is that that person's placing in there, and the death benefit that the company's going to be paying out. So if we have $1 million death benefit, well, then obviously those costs are going to be higher because if that person passes away, then $1 million is going to be paid out to their beneficiaries, as opposed to somebody that has a $500,000 death benefit. Obviously, those costs are going to be lower. Now, the amount of dollars that somebody places in there, if you're going and you're understanding this little egg shape, well, if you have a maximized death benefit plan, well, then you're going to have a substantial amount of dollars that are going to the costs and those different expenses, and then a smaller portion that's left over that goes into a type of savings account known as cash value. So the cash value account is going to be credited by the net amount that you're netting from anything above what the cost is per year onto your life insurance plan. And then on top of it, as that bucket is accumulating with the cash value of the net amount, the net amount, the net amount, also the type of interest credit that you're receiving, which we understand if it's an index, then it's based upon the indexing strategy that I explained in the beginning. So therefore, it's going to accumulate by the additional net, and then on top of it, how well that specific index performed. Now, rather than a sort of variable account where if the interest rate comes back negative, that negative interest rate is going to negatively impact your cash value, could actually siphon out your cash value even worse. The reason why the index is very important is because in a bad market year, you just have a 0% credit into it. So you'll still be gaining because the net amount over the expenses is still going to be accumulating within your bucket year by year by year. So if we understand that concept, what do we need to do to make sure that this contract is maximized? Remember, this is not for the maximum death benefit. This is for the maximum cash value. So what we're trying to do is say for every dollar somebody's placing into this contract, we're going to make sure that this death benefit is as small as possible, because that's one of the factors that are going to decrease those costs significantly. So that when we're setting this up, we want to make sure that the costs and anything associated with that cost of that death benefit is as tiny as possible. So those are the expenses, and then everything remaining is going and is building up the cash value. So we're kind of reversing over that egg shape. Now, be mindful that the death benefit is going to play a very key role, because in order to have maximum cash value growth, there's something known as a cash value corridor, meaning as cash value is increasing, death benefit has to go with it, meaning that your cash value cannot be higher than your death benefit. If your cash value is higher than your death benefit, then if there's a sort of penalty that takes place known as a modified endowment contract, which would deem your entire account taxable. So as individuals are trying to place more and more dollars into that cash value, the reason why that's beneficial is the cash value could be meant for retirement or supplemental retirement income at a later date. And when it grows, every time that this cash value grows, when you set it up the correct way, that money within the cash value will grow tax free. They would still leave a death benefit that would go to beneficiaries tax free. And then most importantly, when it comes time to pull this money out for retirement, that income could come to them 100% tax free. Now, that's the very generic way on how to set these things up. Now, understand there has to be set up a specific way. It can't just say, oh, as long as I'm placing my dollars into an IUL plan, that everything is going to just grow tax-free, be a tax-free death benefit, and my income's coming out tax-free. You have to know exactly how these plans are set up, and they have to be set up through a proper institution the right way. So this is, one of the things that we're very unique, or we set up these policies in a very unique way, hence the amount of national volume that comes into our office, is because we understand the pros and most importantly the cons with this type of plan. And one of the worst things that somebody could do is place dollars into an IUL product thinking that they're gaining all this growth just after 20 years of doing this song and dance, just to realize that all their money was going towards fees and expenses, and they're not able to get those tax-free benefits on the back end. So very importantly, you want to make sure that you're going through an independent agency or financial institution that deals with these things on a daily basis, and they understand how to properly strip away the costs and then be able to provide you with all of these tax-free benefits when getting set up the right way. So let me clear off this. Now, one of the things I mentioned was that, an independent agency, the reason why I mentioned the independent agency was because you have all these different slew of carriers, multiple hundreds of carriers that offer these types of IUL plans in your particular area. And out of those hundreds of different carriers that do it, typically I only go through about the top 5, because a majority of them are complete garbage type products. When I say garbage products, that means that for the person that's looking to get the maximum accumulation value within this type of plan, and we're looking at this egg shape, they're going to dress it up as saying, oh no, you're going to receive this good cash value, but their actual costs are so large that it's very hard for that cash value to grow. So what we have to do is make sure that we're navigating specific to your area, specific to what your goal is, saying, I'm in my 30s, I'm in my 40s, I want to retire by the age 62, or I want to retire when I'm, 55 years old, whatever that case may be. You want to make sure that it's specific to a carrier that strips away those costs, strips away that cost of insurance and all those other miscellaneous expenses as much as possible, so you can have that max cash value, in the process. So that's why typically whenever somebody utilizes our agency and they're dealing with a specialist, first off, you guys are going to become a lot more educated than just randomly going to the advisor up the street and saying, "Oh, I want an IUL plan," and he's going to go through whatever company has basically marketed, or the only company that they could essentially utilize. So we have proprietary relationships out there, making sure that we could essentially get you 10 to 20% higher maximum cash value than the average advisor that's recommending these types of programs. On top of it, your education is going to be far greater than what typical advisors try to educate individuals on these IUL plans. And that's one of the most important aspects. You want to know if you're placing in $10,000 a year or $5,000 a year into these types of plans, or even higher. You want to make sure you understand the pros and cons, as detailed as possible, because out of those, top 5 carriers, there's one in particular that leverages how to decrease that death benefit and how to decrease the amount of risk to that actual insurance company, and therefore the costs are going to be stripped away as much as possible. So let's say if you have the first place guy could essentially give you a 20% higher income amount than what the second place company is going to, offer you as well. And from us, we're not going to be biased towards one company over the next. We're going to always say, hey, listen, as a client, we're going to have your best interest in mind to say these are the top 2 or the top 3 recommendations. This is why we're recommending, company A as opposed to company B or company C. And there's a whole slew of different things that have to be factored into this type of plan. But when set up the right way, you understand, you'll have that peace of mind that's saying, okay, every month I'm placing X amount of hundreds of dollars, X amount of thousands of dollars per month into this type of plan. This plan is going to be growing tax-free. This plan, if I pass away too soon, if I pass away before retirement, or whenever I pass away, my beneficiaries are going to receive a tax-free death benefit. And most importantly, when it comes time to pull this money out, I could pull this money out in a tax-free income way. So there's a couple of different ways on how to truly understand that. My recommendation, if you found value in this video, is to feel free to give our 1-800 number a call. It's 1-800-566-1002. We are A+ rated on the Better Business Bureau. We've never had any complaints. We've always had very good reviews, and it's because of the amount of volume that we bring in, the amount of areas that we cover, and the amount of companies that we're able to offer for each specific situation. On average, for each person that calls in, we go through over 1,200 different strategies and contracts, strategies and products, before we give our top 3 recommendations on what's going to be correct for your situation. When you're calling in, just say I want to speak to an IUL insurance specialist or maximum cash value accumulation specialist, and we offer 24/7 customer service. You could call us mornings, nights, weekends, whatever the case may be, and we'll always have a specialist standing by to answer the phone and to help you out, specific to what your needs are. At the end of the day, it's what's going to be most important to the actual client, not what's important to the company. The company is going to try to be making money. The insurance companies, they're going to try every little song and dance to make as much money as possible. But there's specific niche criteria that an individual could leverage to make sure that they're able to walk away with the best possible leverage, the best possible max accumulation, so that these are accentuated as high as possible. Individuals could go set up IUL plans and they could be happy, they could be satisfied with them with, smaller caps and higher amounts of costs, and they could still get to that finish line successfully. What we're trying to do is make sure that you're maximized, that you're getting to the absolute correct situation, best way possible, the correct benefits, the correct accumulation, and you're not just you're not just going through a random company. You're basically cherry picking which one's going to be ideal for your specific situation. So thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.